Welcome to Wall Street Weekly. Imagine checking your brokerage account on a Friday afternoon.
Right, which is always an experience.
Yeah, but specifically this week. I mean, over the past 5 days, you've watched the Dow Jones suffer a genuinely terrifying 950-point crash.
It's just a total midweek cratering.
Exactly. And, you've seen global oil supplies actively choked off by this military blockade in the Middle East. Plus, you've read all the headlines screaming that inflation just hit a staggering 3-year high.
It's the perfect storm of bad news.
Right. So you brace yourself, right? You expect your portfolio to just be an absolute bloodbath. And yet somehow you look at the screen and 10 out of the 11 major economic sectors are actually up.
Yeah.
Like they finished the week in the green. How on earth does that happen?
It completely shatters our traditional understanding of market contagion, honestly.
Yeah.
Because normally a macroeconomic shock of that magnitude, it acts like a tidal wave. It just washes over everything.
Right. Everybody runs for the exits.
Exactly. But what we witnessed during the week of June 8th to June 12th, 2026, it was a market that didn't panic and flee into cash.
Huh.
Instead, it radically, and I mean aggressively, rewired itself from the inside out.
And that rewiring is exactly what we're going to tear apart today.
Yeah.
We are going really deep into the comprehensive Wall Street Weekly report that covers this exact stretch of market action.
Which is absolutely fascinating to unpack.
It is, because the goal here isn't just to, recite what happened. I mean, you can get that from a ticker tape. We want to understand the actual mechanics of this paradox.
Look, underlying machinery.
Yeah. We're looking at a week defined by scorching inflation data, a sudden panic over tech sector share dilution, and an absolute roller coaster of geopolitical U-turns in the Middle East.
Oh, the whiplash was real.
Definitely.
Yeah.
And through all of that, the market didn't collapse. It staged this massive structural rotation.
Which, is really the ultimate sign of a highly mature, complex financial system. Well, when confronted with an energy shock and an inflation spike, institutional capital didn't just evaporate. It systematically hunted for the exact pockets of the economy that would actually benefit from the chaos.
Wow. But to understand that rotation, I feel like we have to start with the wrecking ball that swung through the market midweek.
The inflation data.
Exactly. We have to talk about inflation because the data that dropped was, frankly, terrifying.
It really was.
The Bureau of Labor Statistics released the Consumer Price Index, the CPI, for May 2026, and headline retail inflation climbed to a scorching annual rate of 4.2%.
Yeah.
Which is the hottest reading since April 2023.
And, 4.2%, that's a psychological threshold.
Oh, really?
Yeah, it's a number that basically forces portfolio managers to completely abandon the narrative that inflation is fully defeated.
Right. It's just too high to ignore.
But as analysts, we have to dissect that number. Because a headline CPI figure is really just a composite. It's a basket of goods. When you break that basket apart and isolate the underlying mechanism driving the surge, you find a single glaring culprit.
Energy. It was an absolute energy shock. I mean, looking at the report, the CPI energy costs surged 23.5% annually.
Which is just a massive jump.
Let's just pause on that. Nearly a quarter increase in the fundamental cost of keeping the lights on and moving physical goods from point A to point B.
Yeah.
And that's just at the retail level. The real horror show in the data was the Producer Price Index.
The PPI. Yeah, this is arguably the far more critical metric for predicting corporate behavior.
And future earnings, right.
Exactly.
Because PPI is, it's the factory date inflation, and it jumped 1.1% for the month of May, and a massive 6.5% year over year.
Unbelievable.
That is the highest since November 2022. And the sources show that nearly 80% of that PPI advance was driven by a 10.7% monthly explosion in energy goods alone.
Right.
Specifically, like a 23.4% spike in spot gasoline.
Think about what that literally means for a manufacturing business. Before a single product even leaves their loading dock, their fundamental operational costs have skyrocketed.
Right, like the diesel for their forklift fleet.
Exactly. The diesel, the electricity running their assembly lines, the petroleum-based resins they use for packaging, the cost of all of it is accelerating.
Yeah, it adds up fast.
So when factory gate inflation hits 6.5%, a company really only has two choices. They either absorb the cost and destroy their own profit margins, or they pass that cost down the pipeline to the consumer.
And, I mean, companies aren't charities. They're going to pass it down.
Absolutely.
Which guarantees that the CPI is just going to stay high throughout the summer, and we are already seeing the real-world impact of that.
Oh, for sure.
Like, if you were looking at your household budget for the summer of 2026, the numbers are brutal. National average gasoline prices hit $4.16 a gallon.
Wow.
Airline tickets are up 26.7%. Even just running your air conditioner. I mean, electricity costs are up 5.9%.
Yet it acts as a highly regressive tax on the consumer. It directly targets non-discretionary spending. People have to drive to work.
Right, but hold on. This is where I actually struggle with the prevailing Wall Street narrative here.
Okay, let's hear it.
If headline inflation is at 4.2%, and we have this terrifying 6.5% wholesale inflation, why is core inflation, which explicitly excludes food and energy, why is that sitting at a totally stable 2.9%?
That is the big question.
Because to me, it feels like having a perfectly healthy car engine. The pistons are firing, the timing belt is in perfect condition, but the price of the specialized fuel needed to run the car has suddenly quadrupled.
Great analogy.
Right. The engine itself isn't running too hot. Consumer spending habits on clothes or electronics aren't the problem. The problem is entirely the global supply line delivering the fuel. So why does the Federal Reserve have to punish the entire economy for an energy problem they literally can't control?
That is the exact trap the Federal Reserve is caught in right now. Your engine analogy is perfectly accurate.
Because they can't drill for oil.
Exactly. The consumer isn't fundamentally overheating the economy through reckless discretionary spending. The core inflation stability at 2.9% proves that. But the Fed only has one primary tool, and that's interest rates. They cannot print more oil. They cannot magically unblock maritime shipping routes to lower the cost of jet fuel.
Right, they can only crush demand.
Precisely. They have to actively destroy demand in the rest of the economy to offset the uncontrollable spike in energy costs.
Wow.
Because headline inflation is heating up to 4.2%, the Fed is practically guaranteed to maintain a highly restrictive, higher for longer interest rate stance.
So expensive mortgages forever.
Yeah, they have to make mortgages so expensive and business expansion loans so punishing that general economic activity cools down enough to balance out the localized inflation happening in the energy sector.
Okay, so if the entire macroeconomic panic, the high rates, the squeezed consumers, if all of that is resting squarely on the shoulders of energy prices, we really have to look at the geopolitical earthquake that triggered this specific oil shock.
We do, because it was massive.
Right, because this wasn't some slow structural decline in drilling capacity. This was a violent overnight disruption in the Middle East.
And the mechanics of that disruption are exactly what drove the extreme volatility we saw in the commodities market.
Yeah, let's trace that. So early in the week, following targeted U.S. military airstrikes, Iran officially announces the complete closure of the Strait of Hormuz.
And, the Strait of Hormuz isn't just another waterway.
Right, it's a bottleneck.
It is the single most vital maritime choke point in the global energy architecture. Closing it effectively suffocates roughly 20% of all global oil transit.
20%, that's huge.
It traps millions of barrels of petroleum and chemical inputs inside the Persian Gulf, completely cutting off international industrial hubs from their primary fuel source.
And the moment that closure was announced, the price reaction was violent. Brent crude, which is the international benchmark, skyrocketed past $95 a barrel.
Yeah.
The U.S. benchmark, West Texas Intermediate, or WTI, leaped past $92.60. And I really want to dig into the literal mechanics of that price action.
Sure.
Because the sources mentioned the Brent crude spread widening dramatically to $3.50 early in the week. What does that actually mean on a physical, logistical level? Like, why does the international price separate from the domestic price so aggressively?
It comes down to the physical risk of maritime transport, which translates directly into insurance premiums.
Okay, insurance.
Right. Brent crude prices waterborne oil. That's oil that has to be loaded onto a tanker and physically sail across the ocean. WTI largely prices oil that is extracted and transported via pipeline within North America.
Ah, so it's not on a boat.
Exactly. So when the Strait of Hormuz is closed due to military conflict, the waters around the Middle East become an active war zone.
So the maritime syndicates like Lloyd's of London, they suddenly just jack up the price to insure those vessels.
Overnight, the risk of a supertanker being seized or destroyed goes through the roof. The cost of maritime freight insurance skyrockets.
Makes sense.
And that massive insurance cost is immediately priced into the barrel of oil as a war premium. So Brent crude becomes significantly more expensive than WTI because it carries the physical risk of the ocean transit.
Wow.
That widening spread to $3.50, that was the market mathematically calculating the cost of geopolitical violence.
Okay, but then we get to Friday, and the entire geopolitical calculus gets inverted in a matter of hours.
Total 180.
Yeah. President Donald Trump calls off planned military counterstrikes and signals a major diplomatic breakthrough toward a comprehensive peace agreement.
Right.
But it wasn't just a political statement, was it? The U.S. military simultaneously reveals they had utilized specialized, undisclosed technology to systematically bypass the blocked waterways.
Yeah, that was wild.
Like they secretly moved more than 100 million barrels of crude oil right past the radar blockades in the Strait of Hormuz.
It is a staggering logistical achievement.
I mean, 100 million barrels. You can't just put that in a backpack. We are talking about massive physical infrastructure. And the moment that information hit the wires, the market reaction was instantaneous.
Well, total plunge.
Brent plummeted from over $95 down to $87.33. WTI crashed back down to $84.88. How does a price collapse that massive happen mechanically? Like, when the news breaks that the oil is free, how do the trading desks actually execute that plunge so fast?
Well, it happens in milliseconds. And it's driven almost entirely by algorithmic trading and systematic fund managers.
Really? It's just algorithm.
Yeah. Throughout the week, commodity hedge funds have been piling into long positions, buying oil futures as a defensive hedge against a prolonged global conflict. They were betting the price would continue to rise.
Riding the momentum of the war premium.
Exactly. But modern commodity markets are heavily automated. Algorithms are constantly parsing global news feeds. They're utilizing natural language processing to read diplomatic statements and military press releases the absolute instant they are published. The moment the algorithms ingest the news of the diplomatic breakthrough and the 100 million barrel bypass, their risk models completely flipped.
The threat was gone.
The immediate threat of a global supply choke dissolved. So the algorithms instantly executed cascading sell orders to liquidate their long positions.
Just dumping everything.
Yeah, they dumped the contract simultaneously to lock in whatever profits they had or to minimize losses. This mass synchronized liquidation is what violently compressed the Brent crude spread back down to $2.45.
Wow.
The war premium was mathematically deleted from the market in the blink of an eye.
The speed of that is just wild. Okay, so we have the inflation data terrifying the bond market on one side and this incredible oil shock terrifying the commodities market on the other. That is the macro environment these institutional investors were swimming in.
A very turbulent swim.
Right. So how did the stock market react? Because if I'm holding a massive portfolio and I see 6.5% wholesale inflation and a temporary military blockade, my instinct would be to liquidate everything and hide in cash.
And I mean, that is exactly what conventional wisdom would suggest. A flight to safety.
Yeah.
But that brings us to the structural inversion. The capital didn't leave the market. It just violently changed lanes.
Let's look at the major indices for the week to see that. The S&P 500 finishes up 0.35%. The Dow Jones finishes up 0.82%. But the Nasdaq, which is the crown jewel of the tech boom, it finishes down 0.16%.
Yeah, it was a profound fracturing of market consensus.
How so?
Well, on one side of the ledger, you had acute technology fatigue. The mega-cap AI darlings, which had been carrying the entire market for months, suddenly buckled under their own valuation gravity.
And buckled is an understatement. I mean, it was a bloodbath in the AI infrastructure space.
Yeah.
Midweek, Supermicro, which is a massive player in server architecture, they announced a sudden plan to raise $7 billion in cash.
Right.
And they're doing it by flooding the market with new ordinary stock and convertible preferred shares. The stock completely craters, down 28%.
Drop.
And it drags the whole semiconductor sector down with it. NVIDIA drops 3.7%, Broadcom sheds 5.1%. So let's break this down mechanically. Why does a company trying to raise cash cause its stock to lose nearly a third of its value in a single day?
It's the mechanics of equity dilution combined with macroeconomic timing.
Okay, walk me through it.
When a company issues billions of dollars in new stock, they are instantly expanding the total number of shares in existence. If you own a slice of that company, your slice just got significantly smaller.
Right.
The company's future earnings now have to be divided among a much larger pool of shares, which instantly lowers the earnings per share, or EPS.
So the fundamental value of the stock you are holding is mathematically diluted?
Precisely. But the timing is what made it a total disaster.
Ah.
Institutional desks were already looking at that 6.5% PPI inflation data, realizing that the Federal Reserve was going to keep interest rates extremely high.
Right, the higher for longer stance.
And high interest rates are highly toxic to growth stocks because the cost of capital is expensive. It makes their promised future earnings much less valuable today.
Okay.
So when Supermicro announced a massive dilution event right in the middle of a high interest rate inflation panic, institutional investors aggressively repriced the risk of the entire AI sector. The tolerance for high valuations just evaporated.
And it wasn't just the hardware companies getting punished. Software got hit with a totally different kind of vulnerability.
Oh, Adobe.
Yeah, Adobe. They reported their Q2 earnings, and the numbers were phenomenal. Record revenues of $6.62 billion. They even raised their 2026 targets based on massive recurring revenue from their AI integrations.
Great numbers.
By every traditional metric, that stock should have skyrocketed. But instead, it tumbled 6%. Why? Because hidden in that incredible earnings report was the announcement that their chief financial officer, Dan Durn, was abruptly resigning to join Marvell Technologies.
Which is the perfect illustration of tech fatigue.
A C-suite change wiped out a record quarter.
Yes, because when a sector is priced for absolute perfection, any anomaly is treated as a systemic risk.
Oh, I see.
A CFO departure, even a seemingly amicable one, it introduces a microscopic element of uncertainty. In a normal market, investors might ignore it.
Yeah, happens all the time.
But in a market where tech multiples are stretched to their absolute limits, institutional money managers use literally any excuse to lock in their gains and rotate out.
And here is the punchline of the entire week. They rotated out of tech, but they didn't leave the casino.
Yep.
They just moved their chips to the lower stakes tables. The capital that fled Supermicro and Adobe tunneled directly into the smaller companies.
It was incredible to watch.
The Russell 2000, which tracks small-cap stocks, exploded up 3.1% for the week. The Russell Midcap surged 2.3%.
Yeah.
And when you look at the 11 economic sectors, materials dominated, up 4.4%. Consumer staples were up 3.3%.
Yep.
Ironically, energy was the only sector to finish in the red, down 1.34%, purely because of that Friday oil crash.
It was a masterclass in capital rotation.
But I really need you to connect the dots here for us. Why did small caps and cyclical materials love the dropping oil prices so much that they staged a massive 3% rally?
It comes back to operational leverage and what we call the energy tax.
Okay.
Mega-cap tech companies like Apple or Microsoft are largely insulated from fuel costs. They deal in software, IP, and highly optimized global supply chains with massive cash buffers.
Right, they are paying for diesel.
Exactly. Small-cap equities, however, are deeply exposed to the physical economy. Regional banks, local transport companies, mid-sized manufacturing firms, their daily operating margins are highly sensitive to raw fuel inputs. When oil hits $95 a barrel, it acts as an invisible, highly aggressive tax on their daily operations. Their profit margins are instantly squeezed.
So when the U.S. military bypasses the blockade and Brent crude plummets back down to $87, it's not just a geopolitical relief, it's a literal cash windfall for these companies.
Exactly. The removal of that energy tax provides an instant mathematical margin boost to these cyclical companies. Furthermore, the midcaps became the perfect soft landing bid for institutional managers.
Explain that. What makes a mid-cap a soft landing bid in this environment?
Well, it's a structural sweet spot. Mid-sized companies don't have the dangerously overextended, sky-high valuation multiples of the mega-cap tech giants.
Okay.
So when interest rates stay high, their stock prices don't collapse under the weight of unrealistic expectations. But concurrently, they have much more robust, durable balance sheets than microcaps or highly speculative startups.
They actually make money.
Right, they generate cash flow, so they won't go bankrupt in a restrictive credit environment. They offer the perfect balance of reasonable valuation and structural safety.
Okay, I buy that for manufacturing and regional banks. But I'm looking at the sector breakdown, and there's a glaring contradiction that I have to challenge you on.
All right, lay it on me.
Real estate. The real estate sector finished the week up 3.02%. Wait a minute. You just told me that the 4.2% CPI and the 6.5% PPI practically guarantee that the Fed is keeping interest rates high.
I did.
Real estate investment trusts, or REITs, are incredibly rate sensitive because they are heavily debt financed. High interest rates usually crush real estate. So why on earth did the real estate sector rally by 3% in a week, defined by an inflation shock?
That is a very sharp catch, and it highlights the complex, forward-looking nature of the fixed income market.
Okay.
To understand the real estate rally, you can't just look at the Federal Reserve's short-term overnight rate. You have to look at the long end of the yield curve, specifically the 10-year Treasury yield.
But shouldn't long-term yields go up if inflation is high?
not if the bond market believes the inflation spike is temporary.
Interesting.
See, when the diplomatic breakthrough in the Middle East happened and oil prices collapsed on Friday, it completely deflated the broader long-term global inflation premium.
Oh, I get it.
Bond traders looked past the immediate, terrifying CPI print. They realized that without $100 a barrel oil permanently embedded in the supply chain, long-term inflation expectations would actually cool down.
Oh.
Consequently, the 10-year Treasury yield, which dictates mortgage rates and commercial real estate financing, actually edged lower toward the end of the week.
So the real estate market wasn't reacting to Wednesday's inflation panic. It was reacting to Friday's oil relief.
Exactly. The worst-case scenario for real estate, which would be a permanent escalating energy inflation spiral, was taken off the table.
Right.
As long-term yields consolidated, those heavily indebted, yield-sensitive REITs caught a massive relief bid from investors who realized the catastrophic downside risk had just evaporated.
That is fascinating. The stock market is playing checkers, reacting to the daily news, and the bond market is playing chess, pricing in the macro reality 3 moves ahead. Which actually perfectly transitions us into the day-by-day psychology of the week. Because when we just look at the weekly numbers, the S&P up a fraction, the Dow up almost 1%, it completely sanitizes the emotional whiplash that traders actually endured. I want to walk through the chronology.
The daily timeline is crucial. It perfectly illustrates how modern markets are completely dominated by event-driven algorithms and micro-shifts in sentiment. Fundamental realities were literally shifting overnight.
Right. So Monday opens, and it is all about dip buying tech optimism. We had just come off a tech liquidation the previous Friday, and traders were eager to get back in.
Yeah, buying the dip.
Marvell Technology gets fast-tracked into the S&P 500. The stock pops 10%, and it pulls the entire chip sector up with it. The mood is euphoric. It's like the inflation storm isn't even on the radar.
It was an echo chamber of Wall Street optimism, completely detached from the macroeconomic reality that was quietly brewing in the background.
Because Tuesday hits and reality reasserts itself. The pre-CPI jitters set in. The big money realizes the inflation report is dropping tomorrow. Suddenly, the tech euphoria evaporates. Apple drops 3.6%, simply because some analysts start expressing vague doubts about their Siri AI monetization timeline.
Spooks.
Meanwhile, defensive stocks start catching bids. J.M. Smucker pops 10% on a massive earnings beat. You can literally watch the smart money fleeing the growth sector and piling into defensive staples like peanut butter and jelly.
Tuesday was basically the bracing for impact. The institutional desks knew the inflation numbers were going to be hot. They just didn't know the exact magnitude, so they de-risked.
And then Wednesday arrives, the darkest day of the week.
Oh, man.
The perfect storm of macro anxieties and corporate vulnerabilities colliding. The 4.2% CPI data drops. The super micro $7 billion dilution hits the wires.
Awful timing.
To make matters worse, President Trump issues a harsh public warning to Iran, declaring they would, quote, pay the price for delayed negotiations, ratcheting up the geopolitical fear.
Yeah.
The Dow Jones Industrials completely crater, crashing 953 points. The Nasdaq plunges 509 points. It felt like the floor was giving out.
Wednesday was total capitulation. It was the moment when every single risk model was flashing red simultaneously.
And Thursday offered zero relief. The blistering 6.5% wholesale PPI drops. Iran officially announces the physical closure of the Strait of Hormuz. Global equities sink. We see the South Korean Kospi drop 4.5% overnight.
Ouch.
The narrative was cemented. We are heading into a global recession triggered by a structural energy crisis.
But, the psychology of markets is deeply tethered to the resilience of the American consumer. And that is what turned the tide on Friday.
Friday, the Great Relief Rally. The University of Michigan releases their preliminary June Consumer Sentiment Index. Now, consumer confidence had been sliding into the abyss for 4 straight months.
Right, it was looking bleak.
But suddenly, it unexpectedly snaps that slide, rising to a reading of 48.9. Concurrently, the Hormuz blockade bypass is revealed, oil tanks, and the stock market absolutely soars, recovering almost all of its losses.
Amazing.
But I want to really dig into that sentiment bump. The index only rose fractionally, from 44.8 to 48.9. Why does a tiny fractional improvement in a survey of 500 households trigger massive, multi-billion-dollar institutional relief buying?
Because the absolute number doesn't matter nearly as much as the trajectory.
Oh, really?
Yeah. Baseline confidence remained historically low, but the 4-month downward trajectory reversed. In finance, the second derivative, the rate of change is everything. The bleeding had stopped.
But here's the crazy part. The sources specifically note that this reversal in consumer psychology was fueled almost entirely by a slight localized cooling in retail gasoline pump prices early in June. That's it.
Unbelievable.
It just goes to show how hyper-focused, almost irrationally focused the American consumer is on the price of gas. A tiny bit of breathing room at the pump was enough to make people feel marginally better about the economy, which in turn gave hedge funds the confidence to buy equities again.
It emphasizes that institutional investors are no longer just trading earnings multiples or discounted cash flows. They're actively trading micro shifts in consumer psychology.
Yeah.
The market is hyper-reactive to sentiment.
Now, we've covered the equities, the rotation, and the daily emotional roller coaster. But to get the truly complete picture, to look at the deep underlying currents of this market, we need to look at the volatility barometers.
Absolutely.
Because this is the data that absolutely stopped me in my tracks while reading the Wall Street Weekly report.
The derivative fear gauges often tell a much truer, more mechanical story than the headline stock indices.
Exactly. So we look at the VIX, which tracks implied volatility in the stock market, commonly known as Wall Street's fear gauge, and we look at the MOVE index, which tracks implied volatility in the Treasury bond market.
Right.
Usually when a systemic panic hits, they move in tandem. Stock traders panic, bond traders panic, everything spikes. But this week, they completely and totally decoupled.
It was one of the most profound divergences between equity and fixed income psychology we've seen in years.
Right. So the VIX tracked perfectly inversely with the S&P 500. When the stock market crashed 950 points on Wednesday, the VIX spiked to its highest level of the week.
Which makes sense.
It makes intuitive sense. Stocks go down, fear goes up. Options desks scramble to buy short-term put contracts for downside protection, driving up implied volatility.
Standard behavior.
But the MOVE index, the bond market's fear gauge, did the exact opposite. It peaked on Monday and Tuesday and then drifted down for the rest of the week, even during Wednesday's massive stock market crash. Why on earth did the bond market calm down while the stock market was in absolute freefall?
This is one of the most elegant mechanics in modern finance, and it comes down to what equity traders fear versus what bond traders fear.
Okay, tell me.
Equity traders fear losing capital. They fear that corporate earnings will compress and stock prices will fall. Bond traders, however, do not fear bad news. They fear uncertainty. The MVE index is driven by monetary policy uncertainty. Specifically, the inability to accurately predict the Federal Reserve's future interest rate path.
Okay, so on Monday and Tuesday before the data drops.
On Monday and Tuesday, bond traders were operating under intense stress because they didn't know how bad the CPI and PPI numbers were going to be. Could it be 3%? Could it be 7%?
Right.
The distribution of possible outcomes was enormous. The uncertainty was at its absolute maximum, which means they couldn't confidently price the yield curve. Hence, the MVE index peaked.
The fear of the unknown.
Exactly. But on Wednesday and Thursday, those terrible numbers, the 4.2% CPI and 6.5% PPI, were finally released. The worst-case scenario was mathematically confirmed.
Yeah.
But here's the paradox of fixed income. Confirming a worst-case scenario actually removes the uncertainty.
Oh.
Once the 6.5% PPI was a known fact, bond traders knew exactly how the Federal Reserve would react. The Fed's path keeping rates highly restrictive was locked in. There was no more guessing game. The probability curve collapsed into a single certainty.
So even though the news was horrific, the fact that it was certain allowed them to price the bonds accurately.
Precisely. The implied volatility in the Treasury curve drifted steadily lower because the bond market had its final answer.
Makes total sense.
The equity market, meanwhile, was still panicking on Wednesday because stock traders were trying to figure out how that painful answer, higher interest rates, would ultimately impact future corporate earnings. That's why the VIX spiked while the MOVE dropped.
I genuinely love that. It's a brilliant distinction. The bond market doesn't fear bad news. It just fears unknown news.
Exactly.
Okay, I have one more metric I want to push you on, and it's regarding valuations. The Shiller PE ratio.
The cyclically adjusted price-to-earnings ratio.
Right. We use the Shiller PE because it smooths out corporate earnings over 10 years, adjusting for inflation. It's a long-term valuation anchor, removing the noise of quarterly fluctuations.
Yep.
The report notes that the Shiller PE dropped sharply during Wednesday's crash, reflecting multiple compression as investors dumped expensive tech stocks. But by Friday's close, it had rebounded to finish essentially flat, down only a negligible 0.58%.
Which is very telling.
Doesn't that metric completely undermine the idea that the market is fatigued or fundamentally rewiring? Doesn't a rebounding Shiller PE prove that Wall Street's long-term speculative appetite is completely unbroken? Like, they just viewed Wednesday's terrifying 950-point crash as a Black Friday sale on stocks, didn't they?
You're touching on the ultimate resilience of the institutional allocator. It absolutely proves that structural demand for equities remains incredibly robust.
Yeah.
Think about the psychological gauntlet these managers ran through. A massive inflation shock, a multi-billion-dollar tech dilution panic, and a literal military blockade of a vital global shipping lane.
Yeah.
And despite all of that, capital did not permanently flee to the safety of cash or gold.
They bought the dip.
They bought the dip aggressively. When the Shiller PE rebounds instantly like that, it means institutional portfolio managers treated the midweek macro crash not as the end of the cycle, but as a premium entry point. They used the panic to purchase structural growth assets at a slight discount. The fact that the valuation multiples remain historically high tells us that the market's fundamental belief in the long-term earnings power of the American corporation is completely unshaken.
That is the ultimate takeaway. The system bends, but it refuses to break.
Exactly.
So, having dissected the sheer survival mechanics of this bull market, and it really was a survival test during that week of June 8th to June 12th, we have to look ahead.
We do.
We've survived the crucible. But what specific data points are going to test this newly broadened, small-capitaled market in the coming week, June 15th through June 19th?
Well, the macro docket for the upcoming week is packed with Tier 1 data that will serve as a critical validation test for this new rotation.
Okay, what are we looking for?
On Wednesday, we have the Eurozone CPI, U.S. retail sales, and arguably the most important event of the month, the Federal Open Market Committee, or FOMC, statement.
Oh, that's huge.
Yeah. And then Thursday brings the Philadelphia Fed Manufacturing Index and initial jobless claims.
I want to zero in on that FOMC statement on Wednesday. If you are looking at your portfolio next week, knowing that wholesale PPI inflation is running at a staggering 6.5%, you have to listen incredibly closely to the tone of that Fed statement.
Absolutely.
Are they hawkish, signaling that they might actually hike rates again to fight the energy shock? Or are they dovish, suggesting they agree with the bond market that the oil spike was a temporary geopolitical anomaly?
Right. It's all about the nuance.
Their language, specifically the subtle changes in their forward guidance, will dictate the trajectory of the bond market for the rest of the summer.
And beyond the macro data, we have a fascinating corporate earnings calendar that will perfectly pressure test the macro theories we've just discussed.
Who's reporting?
On Wednesday, we hear from CarMax and Jabil. On Thursday, Kroger and Accenture.
I love how beautifully these specific companies map to the macro problems of the week. Take CarMax, for example.
Good one.
We just spent 20 minutes discussing how the Fed is forced to keep interest rates high. Well, CarMax is going to show us the visceral, real-world damage of those higher-for-longer rates.
Yeah, they really are.
Analysts are going to be tearing apart their auto loan delinquency metrics to judge the health of consumer credit. Subprime auto loans are often the canary in the coal mine for the consumer. If people can't afford the 9% or 10% interest rates on a used car, CarMax's volumes are going to plummet, which tells us the consumer is fundamentally breaking.
Exactly. It's the micro-validation of the macro theory. And Kroger's earnings on Thursday will be the perfect lens through which to view that 6.5% PPI wholesale inflation.
Ah, because of food costs.
Right. Kroger operates on razor-thin grocery margins. Institutional investors will be scrutinizing their forward guidance to see how well they are managing their pricing power.
Okay.
Are they being forced to absorb the higher logistical costs of food packaging and diesel transportation, crushing their own margins? Or are they successfully passing those exact costs onto the consumer through higher grocery bills without losing market share?
If Kroger can pass the costs on, it means consumer food inflation is going to remain incredibly sticky.
Yes. Their report will be a live read on the inflation pipeline. And then you have Jabil and Accenture, which map perfectly to the tech, fatigue, and AI dilution story we analyzed with Supermicro.
Walk me through that.
Jabil is a massive manufacturing partner for global tech companies. The market will dissect their hardware order visibility to judge the real-world physical demand for AI data centers.
Right.
Is the infrastructure demand actually accelerating? Or was the Supermicro dilution a warning sign of a broader hardware slowdown?
And Accenture is the other side of that coin. They will show us if enterprise companies are actually deploying capital into AI consulting and implementation, Or if it's all just boardroom hype. Are Fortune 500 companies paying Accenture to build AI systems, or are they tightening their belts because of the cost of capital?
These earnings reports are the ground truth. They will either validate or completely invalidate the macroeconomic rotations we witnessed this week.
It is going to be a fascinating week to watch.
Oh, without a doubt.
So to bring this all together, to synthesize this massive deep dive into the mechanics of the market, I mean, the ability of this financial system to absorb a 4.2% retail inflation shock, a $7 billion tech equity dilution, and a literal military blockade of a vital global shipping lane without breaking the long-term bull market is incredible.
It really is a marvel.
It proves an immense structural depth. The rotation of capital into small caps, regional banks, and cyclical materials shows a maturing, highly diversified rally. It's not just a fragile house of cards propped up by 5 mega-cap tech stocks anymore.
No, it is a fundamentally healthier market architecture.
Yeah.
When capital recycles internally, moving from overvalued tech into undervalued cyclicals, rather than fleeing externally into cash, it demonstrates a deep-seated systemic confidence in the underlying economic engine, even if the cost of the fuel running that engine is temporarily exorbitant.
Which leaves me with a final, provocative thought to ponder as we wrap up. We spent the last hour detailing how capital violently rotated out of the mega-cap AI darlings and aggressively tunneled into unglamorous regional banks, heavy industrials, and defensive staples.
Right.
If that rotation holds, are we witnessing the end of the speculative tech hypercycle? Have institutional investors, spooked by inflation and high rates, suddenly remembered how to value traditional, unsexy, cash flow-producing companies again? I highly recommend keeping a very close eye on the performance of those mid-caps next week.
The era of zero interest rate, growth at all costs, euphoria may indeed be permanently behind us. The market is no longer paying for promises. It is actively demanding tangible operational resilience.
And that's exactly what makes observing these mechanics so endlessly fascinating. The best investors aren't the ones who can predict tomorrow's geopolitical news headline or guess the exact CPI decimal. The best investors are the ones who understand how the underlying mechanical gears of the market, the algorithmic unwinds, the bond volatility, the sector rotations will physically react to whatever that news happens to be.
Absolutely.
Keep looking past the surface data, keep questioning the mechanics, and we'll see you on the next deep dive. If you enjoyed Wall Street Weekly's market analysis, subscribe and leave a comment wherever you listen to your podcasts, and follow us, Wall Street Weekly, on YouTube so you never miss a market update. We will be back next week with more weekly insights and analysis from Wall Street. Thank you for listening.